back. You're watching the 80 Money Show with me, Kavita Thapliyal. Now, in the world of mutual funds, each investor is different from the other. While some have higher risk appetite and are willing to take bigger and bolder risks, there are many who tend to be conservative in their outlook. Now, if you are a conservative investor, this segment is for you. We will give you a complete guide on how to navigate your way through equity markets. Let's welcome on board Abhijit Choksi, founder Stockify.in. Abhijit, welcome to the show. So we need equity to beat inflation, and that's something we need to explain a conservative investor who doesn't understand equity markets or fears market volatility. So to begin with, who exactly will be a conservative investor according to you? Let's just start with this.
Yeah, right. So there are mainly two types of investors. Either you are in a wealth preservation mode or you are in a wealth expansion mode, right? So whenever you are investing with a mindset of growing your capital, generally you tend to invest in asset classes where there is some element of risk, but then also the chances of returns are also very high. So anyone who has an objective of wealth preservation, they would be generally classified as someone who is a conservative investor and who would be investing in assets where the amount of risk is very low, and but with less risk, the reward is also pretty low. Like for example, um, I'm sure talking to your friend, you might have heard that their father would be extremely skeptical of the stock market. The person would be salaried and he must be working for years, and they're like, नहीं हम तो stock market में पैसा नहीं लगाएंगे, we will only invest in FD because we want a surety of returns and safety of return is the highest priority. So somebody who has exposure to asset classes which are very low in risk would be considered a conservative investor.
But then, if we have to go step by step, so what should be your first step in introducing equity in your portfolio, Abhijit?
Correct. So like anything in life, if you introduce a change gradually, it generally aligns well over a sustainable period. So in the same way, in equities also, I would recommend that suppose if an investor has been a conservative and has been only exposing his wealth to very safe asset classes, what he can do is gradually start investing, introducing equity. Like for example, suppose he has for example, 10 lakh ka net worth and almost all of it is in debt instruments or FDs, something like that. So from this year, he can start with, let's say, he will invest 1 lakh in mutual fund or he will invest 1 lakh in direct stocks and rest 9 lakh, he will keep it parked in a safe investment. And then gradually he will witness the returns over the years. And then every year he should be increasing some allocation, he should be increasing in risky asset class such as equities. And other thing I would like to add here is that one should only invest in equities if that money is not to be used for at least next 4 to 5 years, because we all saw that how everyone gets enamored by the fact that equities give very quick short-term returns, and then they end up betting the savings with a very short-term horizon, and then they end up losing everything. So unless your horizon of investing is at least 5 to 7 years and above, one should avoid investing in the stocks because it is a high risk asset. But with the right guidance, with the right stock advisor, one can definitely create a balanced portfolio and beat inflation by at least 2 to 3x at a portfolio level.
So, Abhijit, inflation is actually a reality, okay? What will you lose by keeping all your money in fixed income? And how and why will your money also lose purchasing power if at all you have all your investments just done in debt or fixed income and not equity?
Right. Yeah. So let's take an example, like two examples. The first example would be we take a 100 rupee note, we keep it in a cupboard and lock it for 10 years. So now, suppose with that 100 rupees, I'm able to buy, let's say, 5 liters of milk, for example. I'm sure 10 years down the line, the equation is going to be different. Why? Because inflation is going to eat through your purchasing power, and apparently the value of those 100 rupees is going to be reduced. So if you are able to buy 5 liters of milk today, then maybe 10 years down the line, you might be able to buy 2.5 or maybe 2 liters, for example. In the same way, suppose if you park your money in FD, let's say 100 rupees you're parking in FD, and the return of FD is, let's say, around 5%. So, and that also is not tax free, so it's tax deductible. Suppose if you fall in a 30% tax bracket, then after deducting the taxes, you are net getting only 3.5% as a return on your money, versus the inflation is 5%. So net you are losing 1.5%. So that over a period of 10 years, again, you will end up losing. So suppose if you are in your 20s or 30s, and if you decide to park all your money in only fixed deposit, then eventually over a 10-year period, you will see that the money has degrown, right? And uh, it's as good as just parking your money and not investing it, right? So I think that if you are in your 20s or 30s, and if your goal is of next 7 to 10 years, um, just parking in very safe asset classes will not fetch you any return. In fact, it will degrow your purchasing power in turn. Um, consider You can consider that as a financial backlash.
So while we're talking about conservative investors, Abhijit, senior citizens, now normally we recommend them to stay put in fixed income because that's the time of their life where they might not have a continuous income, but and they wouldn't want to take risk with their money also. But now this trend also is seen changing because senior citizens now do have exposure to equity. They not only want returns but also want equity to be part of their regular income. How important it is for senior citizens to be invested in fixed income after retirement?
Right. So I believe if somebody is in the later part of their life, I would still recommend to have at least some exposure to equities, and especially in the context of India. I believe that Indian markets are in their youth. Like, for example, if you consider stock market as a human, then US markets, I would consider them to be in their late 50s or 60s, which are very mature already. They have evolved over the years. And China and Brazil can be considered in their 40s, but when we talk about India, we are in our 20s and 30s. So young energy is there. Plus, markets as an entity is also has a lot of growth yet to witness. So I believe that just because I believe in India's story, anyone who is in their late 60s can have at least a small exposure, maybe 10 or 20% of their portfolio in certain index funds or certain quality blue chip mutual funds, so that they can participate in the India's growth story, which is likely to take um, manifest in next 5 to 10 years. So yeah, I believe at least 10 to 20% exposure should not be discounted, especially in the retirement age.
So Abhijit, talking about having equity exposure in your portfolio, and if that's the first time you're entering equity, what should be the route?
Right. So mainly two things I would like to suggest for someone who has been conservative and who has preconceived notion about the stock markets, that they are risky or they are very high risk in nature. One way would be to invest through index funds. So index funds are basically funds which replicate the indices. So for example, um, it will basically replicate the movement of Nifty. So over past 20 years, Nifty has given around 11.5 to 12% CAGR returns. So, and the entry load of exit load of these funds are also very minor. So it's the fees are not very high. So that way, if you consistently do an SIP in an index fund, that would be one way to expose your um, money to equity markets. But then the horizon, I guess, as we discussed earlier, it should be at least 7 to 10 years and above. Then only it would make sense, so that you can get returns which are inflation beating. And at the end of 10 years, you would want your money to grow uh, post inflation, then only it would make sense, right? And the other way would be to do mutual fund SIPs in quality large cap or mid cap mutual funds, where you can slowly start with a small SIP. And then the key here is to consistently do it despite the whims of the market and the volatility of the market. And over a 5 to 7 year, the effects of SIP is visible if done consistently.
But in the end, one question, can it be the other way around? All equity persons should have a exposure or little investment in fixed income also. Can it be that way? Can it work that way?
Yeah, so again, so the question you asked me, again, this entirely depends on the goal of an individual. Let's say if an individual has a goal of buying a car for next 2 to 3 years, so that money he should ideally be investing in a fixed income instrument, because 2 to 3 year is a very short term horizon to be investing in equities. Because so let's say, suppose what if market does not perform for 2 to 3 years in a row, and the returns does not come, right? So if the goal is for next 10 to 15 years, then definitely equity is a way to go. And as you said, that if somebody has always been investing in equities, uh, and if the age factor is coming in play, then maybe some at least some portion can be invested in the fixed assets, because those are like, those are like the emergency fund, or those fixed instruments, like more like parking your it's like a liquid asset where you can just encash it and utilize it in any form. So yes, some exposure it has to be balanced, right?
All right, although we are talking about how conservative investors can come into equity, but then talking about fixed income investments right now, what is the current bet one can take in this?
In fixed income, I would consider either some government bonds, or there are liquid Bs are there where you can park your money, which does give better returns than fixed deposit. And also, I advise some of my clients to buy physical gold instead of digital gold, because even though digital gold is a bit cheaper, if you compare it, but the problem is with when there is a bull market going on. So I have seen a lot of my clients do this mistake, that they have a gold on paper allocation in gold. They would buy like sovereign gold bonds, but what will happen? They'll see their neighbors and their peers making a lot of returns, so they have this habit of just because digital, you can just sell it a one click away. So they just sell it, convert it into equities. So, and then the whole point of risk diversification goes for a toss. So I always insist them that even though physical gold is a bit, they might be percentage point a bit expensive, but it's better to just buy physical gold and keep it, so that you won't be tempted to just sell it at an impulse and switch it to any other instrument. So yeah, these 2 3 options I would suggest. One is physical gold, second is liquid Bs, and also certain government long term treasuries.
All right, with that, Abhijit, thank you so much for being on the show and helping investors understand why equity is important in their portfolio and how conservative investors can slowly make equity a part of their investment portfolio. We move on.